What's going on, YouTube? I'm Mike with Penner Investments, and today I'm going to talk through the selection of a stock and selling a naked put. Be sure to hit the like button, share this video so others may learn, and subscribe to my channel so you do not miss out on future content. Let's dive in. Selling naked puts or cash secured puts can be done as part of the wheel strategy and typically has decent premiums on the high quality stocks that I trade. I never trade this strategy on stocks that are not high quality, as no-name companies can potentially have their price drop like a rock or could even go out of business, putting me on the hook for thousands of dollars in a loss, and I just don't want to deal with that. Just this past Monday, Salesforce and Meta stocks were down just over 2%, which is my trigger to enter a naked put. I sold 2 contracts on each of these, giving me right around about a $1,500 credit worth of premiums. For the setup on these trades, I have about 15 different stocks that I like to follow. I wait for a day that the stock pulls back 2% or greater before I enter the trade. On a down day with a little more volatility, the option premiums are just a little bit higher. I select the expiration date by looking for the options date that is closest to 30 days out to expiration. On the put side, I like to select a strike price a little closer to the money, as the stock has already had a little bit of a pullback, and the closer to the money that you go, the higher the premium is as well. If I'm trading on margin and want to be a little more conservative, I can select a strike price a little further away from the money to reduce assignment risk. In either case, I like to collect at least a 2% premium, which is 2% of the cost of 100 shares of the stock. As interest rates have gone up, the margin rates have gone up as well, so I like to do anything I can to stay away from margin when possible. I really like to also try and avoid trading the strategy over earnings, as a little negative news can cost me some money if the stock price starts to collapse based on the negative news or a poor report from the earnings call. I like to repeat this process every 30 days on the naked puts until I eventually have a put in the money. Once your put is in the money, there are a few options to choose from. I can either take the assignment of the stock, which I don't mind since I'm only selling naked puts on stocks that I don't mind to own. Or if I'm trading on margin and want to avoid assignment, I can then roll the option out in time, move the strike price further away from the money, and typically this can be done for a credit, although sometimes you might have to roll it out a couple of months to avoid having to pay a debit and able to roll the price down a little bit further away from the money. As always, if there's ever anything you'd like me to discuss further, drop a comment in the box below. Thanks for watching and good luck trading.